Now to a topic every company and industry is talking about, that is artificial intelligence. Joining us now with a look at how AI is transforming that economy. Vanguard's global chief economist and global head of the investment strategy group there, Joe Davis, is with us. He's the author of Coming Into View, How AI and Other Megatrends Will Shape Your Investments. And Joe, it's nice to see you this morning. The big question I think that everyone's always trying to figure out is we always talk about AI in this sort of very broad context, but actually how folks who are sitting at home can actually decide one way or the other to invest or not in AI, and what that actually really means, given that beyond the sort of, big names, the NVIDIAs of the world, the Metas of the world, the Amazons of the world, is there some other way in?
I think there certainly is some other way in, Andrew. And again, thanks for having me. If you can look out 3 or 5 years, and even if you're bullish on AI, you think it's going to transform the labor market, it's going to raise corporate earnings, history is very clear around technology, and that is as it spreads, it gets outside of the tech sector, outside of so-called Silicon Valley, and so it's other parts of the market, non-tech, non-Mag 7, which would continue to, at a lower discount rate, a lower price point, they would start to outperform. Think of a hospital, think of an asset manager or a bank. If AI is truly transformational, it should be raising the productivity of a lot of firms outside of tech.
And so how should, though, viewers think about that piece of it, which is to say, most people aren't investing in hospitals on the back of this idea that AI is going to somehow lower costs. Should they be?
I certainly think so. If you want to deviate from the market, you want to take a little incremental risk to outperform. History is very clear. Again, there's 2 phases to every tech cycle. The first phase is kind of the euphoria. The technology is spreading out. The tech sector tends to outperform, but it's that second half. If you look longer down the chessboard, you start to see the spread. We saw it with electricity, cars, personal computer. You start to see that disruption, and that's where the profitability outside of tech. You can think of a value index. You can think of more concentrated holdings, but you got to look over the production of the technology and more the consumption. What are average companies doing with this technology?
Right. What's the chance that we have a major speed bump in between? A lot of times when there has been a radical transformation in our economy, there is also a collapse at some point too. Which is to say, you go back and even look at the 90s. We did have this dot-com bust, in part because there was an overinvestment in certain parts of that economy. You could look at the fiber that was put in the ground at the time. You could look at some of the venture capital money that went into the dot-com world. Do you think that we're headed towards that?
Well, I think there's certainly an elevated risk. It's one of the reasons why we're cautious on the U.S. stock market. History is very clear. Now, again, you never know the actual timing. We're not in 1999. We're not nearly that stretched. But one of the reasons why some other parts of the market outperform in the back half is in part because all the capital that's going in technology, and that's the irony. The technology ends up being transformational, and yet the investment outperformance can come from other parts of the market. You just got a lot of new entrants into the space.
In your book, you said that there was a conversation that you had with Jack Bogle that led you to study what you describe as these mega trends. Tell us about that conversation.
Well, again, megatrends aren't new, but what Jack asked me over 20 years ago is, say, listen, what we know for investing, what 2 things really matter most, and that's corporate earnings outlook and then interest rates for the bond and stock market. And, can we have some sort of framework looking at all the stuff that's going on in the world to get some sense of where the risks are? Just give me 3 or 5 years out, Joe, is what he asked me. Now, again, that's a tough exercise, but really it has led us to a data-driven framework that's taking tech, debt levels, globalization. We hear tariffs, obviously, in the headlines, and putting this all in one cohesive system. And the results are actually fairly eye-opening. And that's really just the point of the book, is that we're entering a tug-of-war between 2 forces, and everything else is less material, and that is AI versus the fiscal deficits. Both of these are in the headlines, and how those forces play out over the next 3 years will have a large impact on the financial markets.
Okay, so I think I know your optimistic view about the AI part of it. What's your view about the fiscal deficit part of it?
Well, and again, we're really quantifying these effects. I know there is a lot of narratives out there, but we try to push ourselves. What are the odds? Because if you give me the odds, I can construct a portfolio. This is around risk management. And again, what the conclusion is pretty straightforward. Unless AI is more transformative than the personal computer, and there's debate on that over the next 3 or 5 years, the odds are tilted in that way, but they're not a foregone conclusion. If it's not that transformational through automation and workforce impact, then we're talking about significant upward pressure on interest rates over the next 3 or 5 years, and we have a deficit issue. And so it really is this tug of war. I can tell you this, there's an 80% odds we cannot get the economic projections from the Federal Reserve and the Congressional Budget Office, the so-called consensus view. We're tough to generate those because of this tug of war.
But it sounds like if AI, it sounds to me like you're suggesting AI may win the race long term, but short term may lose the race, in which case you do what as an investor?
Well, I think that's, our outlook this year was not new to us. You have to mitigate risks at the margin. So you diversify your U.S. equity holdings, which have outperformed the past 3 years against any portfolio outside of the U.S. There's a lot of talk now on the weakness of the dollar, but that's not a new thesis for us. Last year we looked out of touch. Now we look prescient. I think the truth's in between, and you overweight fixed income, particularly shorter duration, not to be tactical, but really mitigate those risks that AI is longer out in terms of its transformative abilities. Because as you said, Andrew, we're going to have some fits and starts here.